And good morning, good afternoon, good evening, depending on where you are in the world. My name is Michael Filighera. I am with logicalsignals.com, and I'm here to make maybe a little bit of a different type of presentation today. I love the title of this whole series, which is Friendsgiving, and in honor of what the holiday that we're going to have at the end of the month. I felt that it's appropriate. It's like friends giving to other friends, something that might be important, something that could be changing in this world that we call trading. And that it's important to kind of wrap ourselves around, accept, and to kind of move forward with it and use it as an aid to possibly set up some really good trades. Now, and that is algorithms. And as we know, our markets are totally quantitative right now, which means that they're totally operated and controlled by algorithms. So there are trading algorithms, thousands of trading algorithms that are in operation each and every day across the spectrum of all the different sectors that we have, all the different classifications. We have treasuries, we have precious metals, we have commodities, we have equities. And then one on top of that, there are now options being listed on just about everything. And so what we've seen an increase with, not only just in algorithm, the use of algorithms, but we've also seen a dramatic increase in options volume. And so any of you who've been listening to many of the different programs that David produces and puts out, you hear a lot of us talking about this increase, a dramatic increase in options trading. And what that has created, because it's all being done by algorithms, it's created some different stats that actually help us determine of like what's going on and what direction is the market going to go. And the reason I'm bringing it up this way is because these same algorithms are not necessarily responsible, but we find ourselves going like, well, why is the market going up so strongly? Or why is the market going down? We don't really have any news. Has somebody turned bearish? Well, if they're really selling, then we can call that move bearish. But I would bet you 10 to 1 if we went and we actually got in touch with those sellers. It's the algorithm that got triggered by a particular drop in crossing a level. And those levels are really kind of connected via the options. And so if you have any knowledge of options, you realize that we have the Greeks, right? And those would be delta, gamma, theta, vega, the major ones. And so each one has a function, but one that's really kind of gained a little bit additional type of a function is gamma. And so what's now being produced are levels that are showing where institutional traders, big professional traders, retail traders, they're coming in and they're putting on positions. And these positions are producing positive gamma or negative gamma at particular levels in the strike prices. So those also then equate to levels within the futures market and also within the underlying stocks themselves. And so they get classified as gamma levels. And there's different things different titles that they can give them. We have call walls, we have put walls, we have large gamma positions, and they can be ranked by attaching different numbers to them. And their importance is also going to be is like how much of a gamma is sitting there and what level is it sitting at and what does it represent. So now accepting that. So here's the deal. We have algorithms that are in the producing these levels, right? Because they're producing the trades. And so I've had to go through and I go, okay, what are the most important levels that we really need to pay attention to because it's going to produce a directional change in what the options are being traded and what's happening underneath that. And for example, saw this happen today. Now, if you're just looking at this chart, you're like going like, okay. In the NASDAQ, oh yeah, okay, we came down, we hit that low, and look, now we're just rallying back up. So that obviously finished something. And yes, I need to update my own count, the Elliott count, to coincide with what actually happened. And so, but more important, what we saw here in this selling, let me go down to the 15-minute chart. It's going to be a little bit cleaner. Now, this happened yesterday into the close. And then when Globex reopened, they just did a nosedive. And then it hit a level. And then they just started to buy it all back. Now you wonder, it's like, well, what was the selling all about? Well, obviously, it's like what coming down, it broke through a gamma level. And so options aren't trading at this particular time. But the traders themselves knew that they're going to have to make an adjustment. And when they made that adjustment big enough and they got it all the way down to where they wanted it and they got everything all straightened out, that got lifted in terms of the power that the selling had. So whether they were monetizing, whether they were adjusting a position or whatever, the action was to sell because of what the level that they broke and what significance that level may have had. Now, one that I find very, very important, and it's algorithmically controlled, is a volatility trigger. So basically, when we're looking at a market and we're looking at the options trading, there are two basic ways that I think that the market operates. It's either doing a risk on trade or a risk off trade. So that what's important to remember is like, and those are wrapped around a volatility trigger, right? Because the number one function within it, like in risk on trade, what institutions, traders, whomever is doing, once a volatility trigger is triggered to the upside. So in other words, you come in and you realize that your volatility trigger is above the market, as it was today, as a matter of fact. And so when that got taken out, it flips the narrative from risk off trading to risk on trading, because on this decline, we broke the volatility trigger in the NASDAQ, in the Qs, in the spiders, in the S&P. So that flipped the trading back to risk off, which again, what happens then, oh, sorry, I just stepped in front of myself. I want to explain what risk on, when that happens, what is that trade? Well, what they're doing is they're selling, I've got to get over so you can see that, and then I got something in the way. They're selling the VIX. Now, this VIX doesn't have, it's not a futures market, so you can't move in and sell or buy, but it's this VIX, it's the future. And they sell it. And then because it's cash, they take that cash, they take that money, and they turn and they go and they buy the underlying volatility within an index, whether that's the SPX or the S&P, or whether it's the NASDAQ, or whether it's the Russell, or depending on which indexes happens to be happening in. In this case, we're going to use the NASDAQ because that's what happened. So they're selling the VIX here. They're taking that cash then, and now they're investing it, or they're putting it into the NASDAQ 100, the options within the major stocks. Today, we saw that coming in Meta. We saw it coming in Tesla. We saw it coming in Google. We saw it coming in NVIDIA, biggest one. Now, I'm going to add one more factor that kind of goes along with this. All of our indexes and our futures, they're cap weighted, so capitalization weighted. So right now, as most of us know, NVIDIA has the largest, it's become a $5 trillion capitalization, $5 trillion. Well, I'm going to use a term that some of you might understand, some of you may not, and I'll explain. So what NVIDIA then has become in the S&P 500 and in the NASDAQ 100 is the top of the food chain, so to speak, or the top of the pecking order. And what I mean by that is they carry the heaviest weighting in the S&P and in the NASDAQ. So in the NASDAQ, it can be as high as 15 to 18% And what that suggests, or what that means, is that when NVIDIA moves, it's producing an 18% equivalent of a move within the futures market, or within that cash market for the SPX and the NDX. So that's a pretty heavy weighting. So it's number one. And then we're really looking at, again, the NASDAQ. What's going to really be in that top 10 are going to be the Mag 7 plus a few auxiliary. And so when you can collectively look at these, for example, when we have NVIDIA moving, we have Apple moving, we have Microsoft moving, those are going to be your top three. And when you combine them, suddenly you're looking at a 25 or a 30%, that those three stocks, the movement in those three stocks would have 30% pull on what happens in the index. That's huge. And particularly, and the same thing can happen like over in the S&P. Now that's an index of 500 stocks. But if the power of what can happen in that index, up or down, is really being given to 3 or maybe 5 stocks in the S&P, that's 5 out of 500. That's a pretty low, having that much control in these stocks. But that's the way it is right now. So the other part I said, when I started my little presentation, I was talking about that there are things that we as traders need to accept. And by accepting them, it's just because that's the way it is. I don't necessarily have to agree with how the indexes are constructed, but I need to understand what effect does that have? Why? Because I'm a day trader. I trade the NASDAQ future. I trade the S&P future. So this information is going to have a direct effect on how I trade. Now I'm going to take it one step further, because now we have these stocks that are in moving. We have volatility triggers. We have call walls, put walls, and these larger gamma positions scattered over, sometimes a wide range and other times a very congested range. And here's what happens. So in other words, like when we're going to go and we break a volatility trigger on the way up, it's triggering the risk on trade. So what are they doing? Well, they're selling the VIX, and then they're taking that cash and they're investing it in, say, Apple, NVIDIA, the stocks that are common to both the S&P and the NASDAQ. So when you see that, now we're going to go one step further. We have dealers, and then we have the traders. So the traders are like the funds and individual traders and retail. They're the ones that are actually maybe selling the VIX and coming in and taking the position in these options across, the stocks that I just mentioned. Now, who's there to sell them the calls or to buy the puts, depending on what they're going to be trading? The dealers. Now, what are the dealers? The dealers are market makers, actually. So if you have a concept of what a market maker is, that's somebody that has an agreement with an exchange, just in this case, where the options are listed, and their agreement is they will provide markets, bid and offer for the investing public. Now, that's the concept. It's still alive and it still works, but now it's algorithmically controlled. So they just push the button and the button goes in and the VIX gets sold, and they turn, and now they start in where they're going to put these, what options they're going to go after and how they're going to buy them or whatever. So the dealer then has to sell those options. Now, if you're selling a call, what's the hedge? They have to buy. They have to buy. That's the hedge. They're buying the underlying, whether that is the SPX, whether that is the NDX, whether that is the triple Qs, whether that is the spiders, anything where these stocks are found, the options will be trading there. So we can get the same effect when they're coming in and they're doing that type of a trade, but in the SPX or in the spiders. or, in any of our tradable products. Now, that has a big effect. And suddenly you're seeing the market, for example, there, right here. What's happened? The market just kind of took off. And I'll tell you why. Right about there, the market broke above the volatility trigger in the NASDAQ. It had already broken above it in the triple Qs. That came at 621, which is pretty early. So what happens? It gets broken. It produces this switch in the strategy in terms of its risk on trading. Now, let me just kind of fill in right now also, well, what's then risk off trading? Risk off trading is actually the opposite. So if we're in a risk off type of a situation, again, using that same volatility trigger, which is now sitting under the market, if it were to come back down and was to break back below that volatility trigger, it is a signal that we're no longer buying the underlying. We need to cover those. So here we go. So now they're not selling the VIX, they're likely buying the VIX. And then what is then that trade that takes place on risk off? The dealer now has to sell. So they go from buying on a risk on, when it becomes risk off, they're selling. That's the hedge. They're selling. And those basically are the two things you kind of need to keep in mind. Because again, here we're going to go back to, we're looking at a market. We're looking at what's going on in the market. And we're like, well, why is it suddenly so bullish? I dare say that the markets, I cannot classify them as like, well, they're bullish. That participant, that bank, that group, they're bullish on Apple. They're bullish on that. And I dare say, no, that doesn't really come into the picture anymore. Why? Because it's called premium. It's called a premium game. And if you're a dealer, if you're a market maker, you live and die by selling premium. And then you hedge it. So what's the premium? Well, if you go look at an option, it has intrinsic value, it has extrinsic value. So most of the time, if you're buying, for example, a call that is that the actual price of the stock is below that, the strike price, it's not in the money. It's out of the money. But yet, the volatility of the implied volatility in that particular class or that particular month might be accelerating, might be going up. Why? Because the demand is suddenly perked up and they're all jumping in to buy these calls. That is what I'm talking about. That's not necessarily producing a bullish move. That's just a function of that the risk off or the risk on trade pulls them in and they're buying options. Yes, because the goal is that they believe that the stock is going to go up, but they may be doing other things with that as well. But it's almost like a self-fulfilling prophecy. Because if they're like, well, I'm buying Apple because I'm buying the calls because I believe the price is going to go up. Well, guess what? It will. Because the risk on trade just keeps building on itself. Which is why you'll see, broke the volatility trigger. Yep, we had one little pullback. But then let me go down. That is my 15-minute. Let me just open this up so we can kind of see inside. There was the initial. And that happened at well, actually about quarter of 10. And they just started to buy it. And then when they broke the volatility trigger, you can see what happened. They were like, boom. It just pushed the market higher because of adjustments that now needed to be made, breaking that level. Then we go drop back into, there was one little correction, and then we started to go again. Now that's the product of they're selling the VIX, and you can actually watch that, put that on your watch list. And you'll see this, when it first came on, the VIX was, I think, up 5 cents or maybe it was down 5 cents, then suddenly it was down 20, then suddenly it was down 25, then 30, then 40, and you just watch this thing go up. Not just the NASDAQ. You can watch it in the Qs, you can watch it in the S&P, you can watch it anywhere. But you'll notice it, and then you can realize, oh, what happened? Well, the volatility trigger got taken out. And then there's additional, as it moves up, there might be a call wall sitting in there. There might be a large gamma position sitting in there. And if they break that, right? So again, on a market moving up, if there's a large gamma position sitting there, it's likely because it's short. It could be short calls. So now we have to think about it. Again, go to the gamma, go to what all of this is. What happens to that position if it's got a bunch of negative gamma sitting with it because they're short the call, and the market breaks above it? Well, who's ever holding that position is not getting longer. So every tick that it moves above that strike, the price, they're losing bucket loads of money, depending on the size of the position. So I just think it's like, John, that's a great question. I'll answer that in just a moment. It's because it's a little bit difficult. There are some available, yeah, but they're all, you got to pay for them. There are services that they provide all of those levels, not only just the volatility trigger, but call walls, put walls, large gamma positions, different things that kind of can be put together to do this. The one that I highly recommend, David, am I allowed to say? That's because it's kind of like I'm giving something to somebody.
Would
But it's actually shout out. Sorry, go ahead.
allowed to say what?
I want to give the name of the firm that produces these numbers.
Oh, yeah, I don't see
Okay. Spot Gamma, and it's spotgamma.com. I find them to be very options oriented, of course, but they've got a bunch of other products, and just how they all are intertwined and combined can just definitely improve if you're a day trader, or definitely improve if you're an options trader. It'll improve your trading when you can understand what's actually behind these moves, and that's why I'm having this conversation now. Friend to friend here, sort of, to speak, because it's important to get an understanding. It's like, wow, look, the Nasdaq's up 250, the S&P's up over 51 points. Wow, that's so bullish. It's like, no. I mean, yes, it is, but what's behind it? Well, I do believe there's a couple of things going on. The market came down very hard last night to hit that level, and that was the point where whatever institution came in to do that, or a group of traders that came in to do that, they finished what they needed to do. And that left the door open. It's like, well, what comes next? They just started buying it up. But it wasn't until that we broke that volatility trigger that we saw things really start to kick in. So I think that what we had on going down the last couple of days, right? Because again, just to kind of think in terms of a market terms, well, why? Why were they just kind of suddenly selling the market off? And let me go back out just to throw this in, because putting this picture together is really what I'm trying to do. Because we're looking at this decline. And we're like, wow, there wasn't any news. So I do daily updates on the S&P and on the NASDAQ. And I said, well, folks, there are times when the market's just going to drop under its own weight. And what I mean by that is things become so overvalued. Was NVIDIA overvalued at 210? Or did they need to make some adjustments? So either dealers or large firms. And so, yeah, they can come in and they can get the market. They could start bringing things down because they're making adjustments. They're monetizing. They're doing different things to positions in anticipation of the next move. So if you follow my work, and also a lot of other people's work, I was looking for this correction, but it was just a small fourth wave in my analysis, with yet a fifth wave to come. And that fifth wave will once again take the market up to new all-time highs and beyond. Does that mean that suddenly we're turning bullish again? In a way, you have to say yes, but in another way, it's because of what is trading in and around it. So another thing algorithms are programmed in is levels, right? Where are things sitting? And so if whatever they're trying to do in the market, there are times when a market can get really thin, a particular futures market or even any of the underlying, the market gets thin. So if they're walking in because they need to buy 50 NASDAQ futures, which is normally a one-up market, maybe through 2 by 3 or whatever, but you need to buy 50 and we're up at all-time highs, it becomes thin. And you'll see how a larger order suddenly will just push this index. Now, granted, also within the NASDAQ, let's be serious for a moment. It's $5 a tick. When's the last time you saw the NASDAQ move in ticks? I mean, anybody who trades the NASDAQ, you're going to kind of get a chuckle out of that. The NASDAQ doesn't move in 25-cent increments. It moves in dollar increments. So now suddenly you're just looking at it goes, like, oh, 24 and a half, 24, 23. It'll just, if there's an order big enough, it'll just slide. And when the orders are coming to the buy side, like they have been, suddenly it'll just move $5 to $10 because Apple's gone up 25 cents. Again, that's why I started with the weighting of the stock in the index. And when you combine that with the top 10 or the Mag 7, which tend to continue to control our markets directionally and how fast, they definitely control the markets. And we've now witnessed that because of earnings, right? We've had earnings in Tesla. We had earnings in Microsoft and Meta. We had earnings in Apple and Amazon. Apple, when first came out, ran it to 282. I don't know if any of you were really watching what was happening in the NASDAQ at the time, but Apple carried all the weight. And the index, I have to go back to kind of show it. I'm not sure exactly where it was, but just like bam, run up, spike up. That's what it was doing. Then they bring it back, right? Amazon, when those earnings first came out, everybody loved them. Bam, add to it. Meta, disappointing, dropped 100 points. Sink it. Microsoft, initially, prior to the earnings, some institution came in and thought, yes, they're going to be the best thing since sliced bread. Bought the stock up to 552, I believe it was. Earnings came out like, okay, no, we're not really all that impressed. And they brought it back. And from 552, now we're trading at 508, and the market continues to go down. But I dare say it's not because they're dissatisfied with Microsoft. Microsoft continues to be a great company. I.e., let's take a look at Google. Google, I don't know if you guys were really paying attention, but when Google reported, do you know what they made in the third quarter? Get this, over actually, no, I'm going to take it back, $1 trillion. That was a quarter, in 1 quarter. That's the massive size of Google. And I mean, I was like, wow. And what did Google do? Of course, it's going to react. What's it going to hold? It's going to hold those levels, but it sells off a little bit, but then it comes right back. Why? Because that company makes money. It makes buckets of money. So another conversation really about how much money is actually swirling around in our marketplace each and every day between, Forex, between precious metals, between equities, between options. We're talking trillions of dollars every day. So here's just something else kind of off of what I'm describing here. But what major factor for me remains important is as long as that money remains in the market, and we saw additional money come in last week, and I believe it was another 50 or $58 billion or something of that nature, and there's still some sitting, and that might be what's coming in now. Market on the sidelines, getting ready to be put in. And so it is, and then we start to go up again. Now, this wasn't necessarily money exiting the market. This was position squaring, in my view, getting ready for the market to kind of come up. Now, back to the original conversation. How the algorithms influence the direction, influence intraday. How many times have you come in and say, oh, we got this great bullish move going. Oh, this is really great. Then all of a sudden it stops, it turns, and it sinks fast. And it's interesting because you really have to take a step back and you have to think, okay, what's the action? What are they doing? Either somebody's getting blown out of a position, right? Or institutions and larger traders are kind of famous for dropping a market. Now, this also goes to options trading, and here's what has also been added, just to go talk about options a moment. We have options that expire every day, 0 DTE options. Now, I'm an ex-market maker. I've traded options on a trading floor. And yes, I'm old enough that we only had a monthly, every third Friday of the month was the options expiration for that month. Now we have weekly, monthly, quarterly, and daily. And not just in the SPX, the NDX, in the Qs or in the spiders. I'm talking about we have 0 DT options in many, many, many different vehicles. And so how does that affect trading? Well, they're not really going like, am I bullish or am I bearish? It's like, well, that's my position, so I'm going to go towards it. I'm going up there or down there. And if it comes time where it's like, well, we're going to get ready for an expiration, and you'll suddenly see the market rally or drop. It's these larger traders and they have larger positions that they're going to go monetize them. And it could be an individual stock. So, and you'll see that more on expirations. Well, now we have 0 DTE. So every day is an expiration in the SPX. And so you're going to see these type of things where, okay, they're going to go down, they're going to monetize a put, a call, and reverse, and then now they're back, they're done. And the market reverses and goes back to what it was doing prior. So is that regulated? I don't think so. Is it illegal? I definitely don't think so. It's just trading. So again, part of the point of what I'm doing is like, if we can just adapt to, number one, accept that algorithms exist, accept that they're in process, they're functioning during the entire trading day. They're just always, everything is algorithmically controlled, right? Down to how we trade. We put our order in, right? And you might put it on a platform. It's an algorithm that shifts it. It's an algorithm that gets it back. So we're dependent upon them. And having said that, it behooves us to get an understanding of what makes them tick, of what they can do. Again, when you have, like, you'll hear some people talk about resting orders or order blocks that might be sitting above the market or below the market. And a lot of times they're put there by big institutions because if it got down there and that order got filled, that's what they need to do for their position. Now, here's the other thing. A lot of times they'll put the order down there and then drive it to their order. Why? Because they need to buy it down there, or take it up because they need to sell it up there. So it's not that I think that an algorithm has been set up to go search for stops. Yeah, they exist, but not on the big level. I mean, that's somebody, oh, I got this really great algorithm that goes and search for stops and then it takes them out. Okay, not a big deal. But I don't think that. So, another part of my point is like we're always trying to determine what's bullish and what's bearish in our marketplace. A lot of these option traders, they are not going in to buy these calls or sell these puts or do these other positions based on, many of them do based on what they think is going to be happening to the underlying. But the bulk of dealers are doing just that. They're dealing, they're providing the market, and they're hedging. And so, as an ex market maker, we lived to sell premium. That was our insurance. That was how we made that money. Because if you could hedge it, which became vitally important, then you're basically locking in the premium. And that's the name of the game. Now, there are various positions that can be put on, and we see them put them on all day long. And so now what they're doing is they're managing their gamma, they're managing their delta while they watch this position come in. So, in other words, if you're selling that premium, then you want to watch that premium contract. And if it's an out of the money option, it's going to contract much quicker as you get close to that expiration. So again, weekly or even daily, you sell it and you watch. And if it's hedged and that option gets close to expiration and it's not close to being in the money, the option will go to zero. You collect that and you cover your hedge. And that's the money you walk away with. So does that have anything to do with being bullish or bearish on the market or on the economy or anything? Nope. It has everything to do with premium. And that's my point today. When we're coming in and we're going to trade, we have to try to think about everything that is taking place. And by the way, the market is continuing to walk itself higher. Why? Because the risk on trade is continuing. See how? When we first came in, it was down. Yep. See, they just sold some more. When they're selling it, they could just be selling it because they have a reason to sell it, or they're selling it to get the cash and go do this risk on trade. And so the market just starts to walk itself up. That's the other thing about risk on. You'll see the market just walk itself up. Let me see if I can bring this down in a 5 minute. 5 minute, please. And we can kind of see how, see, that was a big one. Then it just relaxed, buy it, then relax, buy it, relax. See the pullbacks? Small. That was a pretty good run, right? Goes up from 740 to 829. 740 to 829. You'd think, okay, I should get a little bit better of a pullback. Only back down to 802. Then they're buying it again. Now, being an Elliott Wave analyst, Elliott still continues to work. I can take it from that low. And you go to think, okay, what do I got? 1, 2, 3, 4, 5. That's a 5. There's a 3. There's another 5. There's a 3. And now we're building another 5. But the pullbacks are going to be small. So when you're looking for a larger pullback, you're likely not going to get it. Eventually you will. It'll be more significant. But then the whole thing starts over again. So understanding the options, understanding what all these levels are, the volatility trigger. What does that mean? The biggest thing to take away, volatility trigger, when broken, going to the upside. So the volatility trigger is above the market. When it breaks it, it's going to signal risk on trades. And what is the risk on trade? Well, they're selling the VIX and they're taking that cash and they're going and they're investing in the underlying within that index. Whether it's the SPX, whether it's the NASDAQ, or whether it's, spiders, they're jumping back in and that's where they're going. So again, if you have a call wall or a large gamma sitting above the market, Often what it's signaling is that whatever position is there, large, is likely on the upside, it's going to be because they're short. And that's resistance. It should be resistance. So what happens when it gets broken? Adjustments. Okay, I don't want to be short now. The market broke above. And you'll find that more often that it'll break above when we're in the risk on. And conversely, you'll see things break below what are underneath the market, which is in the opposite, right? Because then it's usually going to be because why? Because they have short puts, short calls, short puts, right? And if you break down and go below it, you're not getting shorter with the market, you're getting long and longer. So every tick that the thing goes down below your level, you're just piling on loss. So if it can go fast, realize that those algorithms have just jumped in. They will make the adjustment. Everything is automatic, which is why, here's the other thing. We need to accept that the algorithms are there. We need to accept that they're going to think and move much quicker than our brain, even though we happen to think that, well, yeah, we're pretty smart people and our brains function pretty quickly, which most often they do. Algorithms don't stop to think, should I buy it? Should I sell it? They just do. And so as a day trader, I'll sit there and go like, oh, wow, that's a pretty nice. Are we going to follow through? Yeah. And sometimes by the time you get in, it's like, oh, they're done for that particular round. So algorithms just react. They just do whatever the command is or whatever the trade is, they just go and do it. Same thing with a dealer. A dealer comes in and sells a bunch of calls. That algorithm knows that they just sold a bunch of calls because it's the one doing it, and immediately turns and goes and covers it, puts the hedge on immediately. And whether that's taking Apple up 10 cents or 20 cents or 25 cents or a dollar, for example, this morning in Tesla, they're doing it again. That's a risk on trade. See, Tesla up 15. Tesla was down this morning. Oh, but see, the volatility just flipped. And so now we're just buying it. And you think, okay, but it gets very thin. And this morning, they just walked in and I don't remember the exact price. I think it was like from 449 to like 554 or something like that, 454. But it just went ding, 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 ding. And then it went ding, 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 ding all the way back down. So buy order to get it up, sell order to take it back down. And now it's just risk on trading. So that's one of the things that can benefit. Then you can go over and you can look to see, well, what are they doing, right? Because now we're pulling in retail. That they just want, if you're a day trader in options, you're just saying, okay, well, I'm going to go buy these calls. And if I can, that were maybe when you bought them, they were out of the money. Now they're suddenly in the money. So your premium is going to get dried up real quick. But again, you're going to go dollar for dollar with the stock. And when you get enough profit, you just sell it. Not because it's like anything else, but I'm a day trader and I made my money and now I'm out. And you can come back and do a different trade, or you can go back and do the same trade again, right? Notice how the Dow suddenly just pops galore. We have to go back and we got to see, well, what's in there? What's in there? Well, NVIDIA's in the Dow now. Apple's in the Dow now, although it's coming back up and not positive yet. We have to think about what's behind it. Look at AMD. AMD put out their earnings yesterday. They didn't like them. Stock is now up above where it was prior to the earnings coming out that they didn't like. So what's really going on there? Risk on trade. Risk on trade. Why? Well, NVIDIA is probably going to blow the doors off. Look, NVIDIA is going up, so we might as well buy this one. Yeah, but they didn't like those earnings yesterday. Doesn't make any difference. Doesn't make any difference. So two things besides all of this that I really want to share. Algorithms. accept them. Don't fight them. Don't think ill of them. Pull them into your circle and consider them a friend, because they will give you a lot of information at different levels and you will pick up good trades. If we're constantly thinking like, oh, I can't fight an algorithm. No, you're right. You won't be able to. But if I accept that they're in there, they're trading, they're just doing what they're being programmed to do. And if I see them moving fast enough, it's like you can jump on a futures market. You can jump into an option and just watch them take Tesla up $15 and then make your money and then be done. So a couple of things. Algorithms are real and they're in operation all day, every day, and every market. Different algorithms do different things. If you have an algorithm in gold, I'm probably pulling in some different information. But again, we have what's influencing gold. Well, we have the cash, which is one. We have the futures market, which is primary. But we have GLD. Guess what trades with GLD? Options. Far greater than the options that trade on gold, on GC. So there's a whole nother avenue. Same thing in silver. We have SI, the silver future. We have SLV. We have the ETF. And then we have all those options. And they trade heavily and mightily and different things. So you have the gamma and you've got delta and you've got theta and you've got everything working there as well. And as those work for or against a position, the hedge changes as well. And so your product, whatever you're trading, is going to be affected by that. So, and depending on if you're trading gold and you're trading silver, we know that the dollar can have an effect on a bullish or a bearish side, depending on what the dollar is doing. That's even relaxing a little bit, by the way. But it is still there. Okay, so algorithms, they're real, they're in operation. Accept that. Use it to your advantage. Learn about them. As somebody asked, where can I get this volatility trigger information, the vol information? There are several. I think that you also can just do a search for like volatility information in options, and see if you can pull up. For example, I gave out spot gamma. I find them to be brilliant. I find their models to be brilliant. And so they're just a really good ad. And they're options traders. So they get what's happening. And they're not really, converting that to it's like, well, we're super bullish or super bearish. They use the words, but the reason behind it is what they're going to say and how the positions they may put on to reflect protection, to reflect, what these gamma levels are telling them, and what happens if the SPX goes above this level, goes above that level. Like, for example, today we had 6,700 on the bottom. If it broke 6,700, it really could have just tumbled right out of bed. But conversely, it didn't. So now that brings about the next one. What was the next one that's important for the SPX? It was 6,800. Now, 6,800 produces adjusting, but it produces adjusting in terms of buying. So when it broke 6,800, suddenly it just kind of started to spark and it gained some traction and it started going up pretty quickly. And now it's trading at 68.26. Now that's the cash market. So, but you can convert that and go look at the S&P, the ES. So the cash is up 55. The future is up 52. What's up with that? So it's a different thing, which has to do with, what's going inside each one. So when we go and we look technically, and we go inside these things, and we get an understanding that it takes away this necessity to are you bullish or are you bearish? And as a day trader, I want to share something with you, and please don't hold it against me because I'm not being obnoxious. I don't care if the market goes up or down. I care if it just goes sideways because it's not going to produce anything that I can be able to do. But I do care that it does move. And all I am going to do, because I'm a day trader, is I'm going to catch the move. So I'm looking for my signals that are going to tell me that it's going to go in that particular direction. And a lot of that comes from understanding the gamma levels, understanding where is that volatility trigger. And they can change, not so much intraday, but they will change, overnight. So the models get rerun. Options are trading all day long. So where are they going to go and change and put these positions now? Somebody comes in and they decide, well, I want to buy 2,000 of this and I'm going to sell 5,000 of those. And those are real trades, by the way. So that's going to set up gamma levels. And so now you're going to have parameters. Excuse me. So when things get there, it can really help you just automatically do your trade instead of thinking like you're not an algorithm, but just go, well, I don't know, should I be buying it? Well, how far is it going to go? Well, then last thing, and I don't have enough time to go into this too deeply, we have things like Elliott. We can plot the graph. I can tell you, well, this is my count. And if it breaks this level, this is where we're going to go. We're going to that next level, up or down. I have Fibonacci. So we have that. And now all I'm doing is building my arsenal of things that I can use quickly because they're dependable. Remember that Elliott is nothing more than just the human emotional reaction to the market. That's what produces the waves. Now, people go like, well, that doesn't make sense. But guess what? Algorithms are programmed. Algorithms do react to a break of a volatility trigger, to a break of a large gamma position, of a break of a call wall or a put wall. They react because they're programmed to. And if you happen to have that position that's there, your algorithm is going to react to cover or adjust that position accordingly. So being that they're programmed, is that basically a human emotional reaction? Yes, just coming from a little bit different angle. So it continues to provide accurate levels. Now, the interpreter or the Elliottician, they're the one, if they're breaking a rule or they're not following how things really should go, then they're likely their count may be off, might not be totally correct. But my work, I'm always going to give you my preferred count, and I'm also going to give you at least one, if not two, alternate counts. And then I also tell you where that would trigger, where that would take over, where we'd have to go look. It's like, nope, it's not this anymore, it's this. And they're usually very related, but one might say, well, I need more downside. I'm looking for additional downside, as it was this morning. But I also gave the level if the market broke. No, then that move is complete, and now we're on to the next move, which is basically what happened today. But at the same time, what I talked about this morning was that we got in, we had finished this, we were up here. I saw that, and I thought, okay, I think we might have one more little up, and then I thought we should go down, and I had the possibility of coming all the way down to there. I said, but if we break that volatility trigger, look for that. And this is likely, and I have to reconfigure this now because that was the low. And it ended that fourth wave coming all the way down. So what does it mean? It means now we're in the fifth wave going up. And if you follow my work, you would have known that I said at fifth wave is going to take us to new all-time highs. Not today, not tomorrow, but it will take us to new all-time highs before all is said and done. And I will track it because it's going to do it in 5 waves. And that's what I'm going to do now. So you have a roadmap. You have an understanding of what the algorithms can or cannot do. In fact, that's the one that triggered it today. It was an algorithm breaking above the volatility trigger. That gave me the move and it gave me the confirmation that this is done. Now, if it turns tomorrow and comes all the way back down, well, then I'm going to have to be counting this very cleanly to think it's like, okay, it could be A, B, 1, 2, 3, 4, 5, C, which would leave it in a fourth wave position and come all the way back down. Am I necessarily looking for that? No, I'm not. But it's now going to become an alternate. So I think as long as you're aware of things, the possibility of things, well, what could trigger it? Well, we're going to be looking for those same gamma levels that could possibly get triggered coming back down. And when they do, it's going to turn the trade. I mean, if they're breaking the volatility trigger coming down, well, back to risk off. And I have seen it go that quickly. So it won't take long because if it goes down, they start to do risk off. But if it flips and goes back up and goes back above that volatility trigger, risk back on. Remember, it's not people sitting there making the decision. It's an algorithm that's programmed by people, but it's an algorithm. So it's just going to do. So, because you might say, well, it didn't go down that far. It just kind of didn't, and it flipped. It's like, be accepting. If you're trading and you got in a trade and you see that it's making money and you're okay with the money, but you're looking for a little bit more, work with a stop. There are ways that we can develop our own trade style that A is going to protect what we're doing and continue to keep the spigot open to make the money. So, but if we don't take all this in and we're not accepting one part of it because we just don't think that it's correct, it's like, well, okay, how's that working out for you? So I think that there's ways to keep ourselves calm, to trade, to just kind of do. Big thing to get over, and I have to share with you, and to be honest, is just being able to do it. When you see it, you go. Now, that's going to be more effective, truly, if you're a day trader, or even if you're trading options, you're just swing trading for the day. That's when you can get into these smaller time frames. Now, because then what you're going to do, say you're going to do trade off an hourly chart, that is showing that we should continue to go up. So notice, look at how on the hourly chart, it's a wonder. So here's how I left this morning. I said, if we do start to go up, we're going to go and we're not going to look back. The market needs to go up without looking back. And that's exactly what it did. Every bar is green. This is an hourly. Yes, we had a pullback. It got swamped by turnaround and the buying. Every bar is green. The writing was on the wall, so to speak. I know I just threw out a lot of information, and I just want to make sure that I can give a few minutes to the possibility of anybody who might have a question. Again, John, just to fill it in, spot gamma is one, but it is a subscription-based product, and they're not cheap. So depending on how much you're going to get out of it, for me personally, I get a lot out of it. And depending on the level of your membership or your subscription, you get a lot. If you're an options trader, they're great. They're really great. So if you're not, there are others that I, again, don't know, but Futures.io might be a good one to go and just to look up volatility triggers or look up, gamma levels and see what they may have on offer. Because there are cheaper ones. I don't think they're super expensive. Some of them might be subscription. Some of them are you just buy the indicator. And I'm trying to think if TradingView might have some. Again, I don't use TradingView. I trade off of Thinkorswim, so I don't have that one in particular. Um, but I'm going to kind of wrap it up. Again, algorithms, I use them, by the way, but I'm using them on my analysis. I plug in my question and my facts into my algorithm, and I ask it to tell me what's the path? What's the path between now and the end of the year? What's the path between now and into the fourth quarter? Because I've been asking that question for a while. And I get very clean, definitive answers. And I get a lot of additional things. You'd be amazed at how smart these algorithms are. And here's the thing, ChatGPT, I imagine many of you already do use it. If you don't, go ahead and give it a try. It's nothing to be afraid of, because I'll tell you what's going on. You go ask ChatGPT a question. It's taking about maybe 5 to 15 seconds to scrape the entire internet and come back and give you the answer. Now, I think, I think my brain works pretty well and pretty fast. There's no way I can pull all of that data, compile it, put it into a nice, neat package, and put it out there. For me to do that research on one person having to go to all these different levels, all these different places on the internet, weeks of time, building the model, running the numbers, weeks of time. That's what artificial intelligence has done for us. Now, you may not like that, but I'm going to encourage to accept that's the way it is, and they're not going away. So we need to kind of embrace it, like it, learn how to use it. If you're an options trader, man, you can put together some queries into just positioning, to hedging, to different products, for silver, for gold, for the S&P, for the NASDAQ, all these different things. And you get all the information, and it'll compile it, and it'll list it, and it puts it out in a very usable fashion. Now, there are models within ChatGPT which you pay per month. They're a little bit more sophisticated. You get a little bit more detail. So they're very usable. But they're here to stay. And more traders are using them. And I will tell you, when you go that route, you're elevating your own knowledge base and you're trading to the level of the big boys, the level of Citadel, Simplex, Goldman Sachs, JP Morgan, that spend billions on artificial intelligence, spend billions to have these algorithms programmed. And now ChatGPT's come along and said, here, go ahead and use it. No problem. So you're getting that quality. And I'm not lying. I'm telling you, you get that quality. And learn how to use it. Learn how to form the question. What information. Now, the ChatGPT's gotten smart, and it'll give it back to you on what the information is. Now, one other thing that I also want to include, because I know he's coming up next, and I think you can go and you can ask them. I don't know if they're superior. I'm being asked of AI such as Grok or Perplexity. I've heard of them. I don't know if they're superior to ChatGPT. I use ChatGPT, and I know others that do as well. So I would say, for me, that is what's best for my trading purpose.